Well, good afternoon, everybody, and welcome to the latest Berry and Oak webinar, where we're going to give you an update on the UK budget. And also, we've got Shane Balkham joining us to give us an update on the investment side. So I'm going to move straight into the slides from today. Sarah and Shane are probably going to disappear and just watch me for a moment, but they're in the background in case anything is needed. So moving quick overview of today, microphones and cameras for yourselves should be turned off so you have no worry about seeing or hearing what you're saying. If you've got any questions, please send them through as an email to the main Berry and Oak email address, clientservice@berryandoak.com, and we'll be picking those up either from myself or for Shane to answer. If we don't answer them in the meeting today, we'll follow up afterwards. Timings today, 15-20 minutes talking to you about the budget changes. Then Shane's probably going to be about 35-40 minutes talk about investments with some time for some questions afterwards. After the event, we will be sending you an email asking you for your sort of feedback, how you found today, any questions you've got about the webinar, and any ideas that you've got for future webinars so we can help serve you better. But I thought I'd just start off with a big congratulations for Sarah. Last week, Sarah was down in London and came highly commended as the financial advisor of the North East. Picture there of Sarah and our operations manager, Ruth, sharing a glass of bubbly. I wasn't invited to this one, and it's fair to say I've not had any of the bubbly either, but very, very well done to Sarah. But let's move straight into the budget, and there's quick sort of high level key budget insights that have come from there. First of all, this was a very significant change in the direction, I think, both politically and economically for the UK. There's very much, a sort of a emphasis on the public sector, huge amounts of borrowing to fund growth, and huge tax rises to also help with that. Tax rising and spending cuts have been measured to be about 40 billion, which is the highest rise in over 30 years. 1993 was the last time it was at this level, according to Sky News. A big part of this came by a substantial increase in the employer's national insurance contribution levels. This is especially true by the reducing of the threshold from when the employer's national insurance starts. I think it's been stated that it's about £900 a year extra for somebody on £25,000 an employer will have to pay. I've seen some quite substantial figures of some big organisations, the amount of increase bills they're going to have because of the budget. And I think Tesco, it's nearly £1 billion that their budget is going to be increased by. Does give me concerns on some of the lower paid workers and part-time workers, despite the increase in the minimum wage, that whether those jobs might become unaffordable for some employers. So we have to watch this space, I think. Capital gains tax increased straight away. So we're now in a new level of capital gains tax. Waiting to find out proposals. How will that work when you do your tax return from gains made before the budget and gains made after the budget? Especially if you've got losses that you're offsetting against gains. How will that work? To be decided. And personal tax rates and allowances on income are being frozen until 28-29. So that means that at least they're going to stay for that period of time, but we have got the worry that fiscal drag might cause more people to pay in tax later on. And there have also been significant changes to inheritance tax, and I think this is an area that will apply to most of our clients, especially those with pensions left, business relief investments, and also farmers. And the big question is, will all these changes or the budget items lead to growth? And that's the big concern, that maybe it's not, because the tax burden might become too high. Now, I could run a little bit of a quiz poll for you now. There's a group of 4 gentlemen on the side. They are actually a band. Could ask people, do we know who they are? Putting out the misery, status quo. So what stayed the same? ISA subscription limits have stayed the same and have been frozen until 2030. So the amount you can put in an ISA, a LISA, or the junior ISA version has stayed the same. It's quite nice from an admin point of view to keep them the same and keep them at a nice round, easy to remember figure. But I think it's more important than ever to make sure you're using your ISA allowance every year. For younger people over 18 have not yet bought their first house, the LISA is a very interesting solution with tax benefits to add to that. And even for those youngsters under 18, considering the JISA, using their allowances as part of the family planning of your finances to make the best, keep it tax-free. As we mentioned, personal income tax bands are frozen till 28-29, when hopefully they will start to raise by inflation. That's what they said in the budget it will do. But as I said, fiscal drag, which is when people, by getting pay rises now, but the band staying the same, finally end up in the next tax band and paying more, is going to push up the tax bill for most people. And then those that invest in VCT, EIS or SAS type investments, there have been no changes. There is a sunset date where tax reliefs will apply for, which has been granted for another 10 years till 5th of April 2035, which gives some sort of comfort to people in those investments that they're still going to be around for a while. And in fact, the government has stated that they want to continue to work with entrepreneurs and venture capital companies to make sure that their policies support a positive environment for growth, because they realise this is one of the areas where younger startup companies are going to provide growth for the economy. One thing that did change was the British ISA. So that's the British piggy bank broken. It was announced in the last budget that we were going to have a £5,000 allowance to go in British investments. I did have a bit of a groan when it was announced in March 24 as another layer of complexity. And whilst it's quite patriotic to invest in UK assets, people might not be happy if UK assets don't make them the money. At the end of the day, people want to make money on their investments, not just be invested in a particular area. And one thing that's sort of interesting in looking at that is this is a snapshot of the FTSE 100 versus the S&P 500, which is the American version, just over the last week. And I've done this to show an impact of the US election and the impact of President-elect Trump now, compared to what's happened in the FTSE. The American market is the red line, which in a week made just over 5%. FTSE 100 fell just over 1%. And really, it's a tale of two different economies, where the stock market is very forward-looking, and it's a measure of how the market sees a region or type of investments are likely to produce returns over a period of time. And this is sort of betting that I believe the markets believe that a low tax, free market capitalism, where government's getting less involved, is likely to thrive more than a market or economy which has got higher tax rates, higher government involvement, higher regulation and restrictions, which is the comparison we've now got between the US and the UK. It'll be interesting to see how this plays out. And over the last few years, and this is something Shane will probably cover in his part, you know, the UK used to be quite a significant part of people's investment portfolios. Now it's getting smaller and smaller because more of the growth is coming from overseas, especially from the American market. We were starting to get a bit concerned the American market was getting quite ahead of itself and doing very well, and maybe time would be changing. But based on our recent UK budget and the potential what might happen in the US, maybe the US is still a good place to be. We shall see. Another bit that came out in the budget was no change to the high income benefit charge. There was plans in March 2024 to move to more of a household income, because there's a bit of a cliff edge really where one family could be earning £70,000 from one earner and the spouse doesn't earn anything and they lose part of the child benefit. But another family, both people earn £59,000, so a combined income in the family of £118,000, and they keep the child benefit charge. But that plan has now been dropped. There isn't going to be a change, and it's still applying, in my view, in an unfair manner based on just the highest earner. Capital gains tax was an area where we've had big changes as well. A lot of this was in the papers beforehand. It was very much in the press, in the stories, that capital gains tax was going to increase. There was high figures quoted of 40-45% for higher rates and additional rate taxpayers. In the end, it's been left where the annual exemption amounts stay the same, which is £3,000 for individuals and £1,500 for most trusts. Downside of that is more and more people are now paying capital gains tax, and this could force them into doing tax returns when they didn't do it before, because there isn't an automatic requirement of investment companies to provide this information to HMRC. So it is down on individuals to make sure they know capital gains they've made and are reporting it if required. But the rates have taxed, and they changed immediately after the budget. So where all the gain matches against the taxpayer's basic rate band, it will now be 18% instead of 10%, and higher rate and additional rate taxpayers are paying 24% rather than 20% before. There's now no additional rate of capital gains tax for sort of second properties like buy-to-lets. Other notable changes, again, it was much trumpeted in the press. It was very much signposted, but VAT has now been applied on private school fees from January 25 going forward, which is going to put up the fees of those going to private education. And stamp duty land tax changed from the end of October for those buying a second property, so typical buy-to-let properties, but also those buying holiday homes. So now you're going to pay an extra 5% on top of the purchase price, which can be quite an eye-watering amount. One of the biggest changes, though, that is going to affect a lot of our clients is inherited pensions, which are now going to be subject to inheritance tax. By inherited pension, this basically means what you've had in a defined contribution or invested style pension that is left at the end of your when something happens to you, what's left behind, where at the moment it would pass free of inheritance tax. Now it's going to be part of the your estate. It's going to apply to both defined benefit and defined contribution schemes. This is actually a very, very complex piece of legislation, and at the moment it's not designed to come in until April 2027, but there's a lot of consultation papers out now about how this will actually work in reality. The expectation is, if you've got an inheritance tax bill, that some of the inheritance tax will be paid out of your pension, but some of it will be paid out of your normal estate, and you don't get the option to choose. It's going to be a formula. It's going to be quite awkward if you've got a number of different pensions as to which pension pays what amount. And it's also going to bring in, for those people dealing with the estate, your personal representatives, a lot of extra work to gathering this information. But we also need to be careful that there could be a double whammy, that not only is the pension now in your estate, but also it will count towards your assets when seeing if you qualify for the residence nil rate band. And there could be instances where you're now over that threshold and start to lose your resident nil rate band. So we could effectively see tax rates on pensions of very significant numbers, because not only losing 40% inheritance tax, but by losing the residence nil rate band, that's going to be an extra tax drag that's going to happen. So we're waiting to see how this consultations progresses and looking at options and solutions to try and mitigate this for our clients. And we'll be picking these up at our upcoming financial planning meetings. Another big change was changes to business and agricultural relief. Again, there's been quite a bit in the press about this since. Agricultural and business relief have been around since the early 90s, and it was designed to stop businesses and farms being broken up on the death of one of the owners, so that the businesses and the farms could keep in the families and keep trading. Now it's going to be 100% of rate of relief on business and agricultural relief for the first £1 million. Thereafter, it drops to 50%. Similarly, those people that invested in AIM investments, that is from April 26 is going to change from getting 100% relief to just 50% relief. The markets were worried that the relief on AIM shares would have removed fully, So actually, when it kept to 50% relief, there's been a little bit of a bounce back on the AIM markets on it from there, as it wasn't as bad as they first intended. But again, something that we're looking at with our clients in their planning and understanding how these changes will affect you, and we'll be talking to you about more in your upcoming meetings. So a couple of things about what did not happen, because again, reading all the doom and gloom and what might happen from the predictions beforehand, despite all the hype, tax-free cash withdrawals on pensions had not changed. It's still the same. I really wish the government would have come out and said that weeks and weeks, months and months before, because I know, speaking to other advisors up and down the country, this was something that a lot of clients were very, very concerned about. And we know there's been a lot of people that don't get financial advice that have drawn money out of their pensions that they probably now regret. And there's been no changes to income tax relief on contributions as well. That remains the same as it is. So it was very difficult before the budget to help people with their planning thoughts based on what might happen and speculation. And it's always something we can only really deal with what we know as the rules and regulations. But at least those for now are untouched, can continue as they are. Which probably just leads me on to just talking just a little bit about interest rates. Interest rates have now dropped down to 4.75%. It's quite interesting seeing, this is the chart of interest rates over the last few years, where they were very, very low for such a long period of time. And then going into 2022, as fears about inflation picked up, which at the beginning, there was a new word raised by investment managers of it, being a short-term period that inflation was going to be, that actually ended up being a lot higher and a lot longer. And 2022, because of the rise in interest rates, became the year that investment markets fell, because stock markets don't like it when interest rates are rising. Markets have been doing well during 2023 and into 2024, with the expectation that rates would start to come down from their peak of 5.25. It's good that we've got ourselves down to 4.75, so it's a start. The projection was going into towards the end of 2025, we might be nearer 3% by then, but there are now concerns that the budget might bring a bit of inflation back, which could make the decline of interest rates still happen, but maybe at a slower rate. But at the moment, investment markets are still pricing in probably at least one more, if not two more reductions in the next 2 or 3 months, which should hopefully lead to further improvements in the sort of stock market investments. And then if it's not been busy enough in the last few weeks with elections and everything else in America, alongside the UK budget, we've now got ourselves the new president-elect. There's going to be lots of news stories around this and what might happen going forward. As I showed you earlier on the slide, the US stock market has reacted positively so far, and it'll be interesting to see what changes he can bring, whether they're good or bad, and how they impact world peace, global economies, and the stock market. But we'll leave that question more for Shane in a few minutes. And getting ready for Shane then now. Shane, Chief Investment Officer at U Asset Management, is coming back into screen now. Shane's going to give us an update on what's been happening on especially their investment portfolios and markets over the last few months, and some thoughts about where markets are right now and what's going to happen next. You don't need to call the US election, we know the answer. You don't need to call the budget, we know we're all poorer. But apart from that, Shane, over to you.
You've taken all the glory bits from me, Andrew. Afternoon, everyone. Going to try the trickiest task, which is to share my slides. Bear with me one moment. So hopefully everyone can see that. So today's agenda, going to cover off performance review. I think everyone would like to know what their performance has been over the past year and a bit longer. Bit of a market outlook. A lot of what Andrew has already covered is hinting at some of the things I'm going to be talking about. And then how we're positioned in the portfolios and what our strategy is going forward. We've also included Manager Spotlight, going to do a bit of a deeper dive on one of the fund managers that we use. And then the education piece, where investment insights, sort of the advantages of staying invested for longer. And we've certainly been given the gift of volatility. We had it over the last quarter, and obviously with the underlying moves that we've had with markets, budgets and elections, that'll be a really good topic to get into. So performance, it's been good. So far, year to date, all of the portfolios are positive. So everyone has made money so far this year. And here's a year's performance on that first line. So from end of September to end of September has been super positive. We always like to focus on the longer term. So if we look at 5-year numbers here, they are extremely good. I'd say the only thing to be slightly wary of here is for portfolios 1, 2, and 3. Their comparator is inflation. And obviously inflation was extremely high over 2021, 2022, and only recently has started coming down. So when you look at the 5-year numbers and 3-year numbers, those high inflation comparators are doing us a slight bit of damage in relative terms. But if you look more recently, when inflation is coming down, we're adding value over there as well. So it's one of those humps we have to get over on the relative basis, but we're massively focused on making sure it's absolute returns that you're getting. So it's about making sure your investments, your hard-earned money, is growing. Now that's our active MPS. We also hit 20 years a couple of weeks ago. So really encouraging that 2 decades we've been doing this and been an exceptionally good job for Andrew's clients. And I hope he would agree with that. We also run Enhanced Passive. That's been running 11 years now. And a similar picture because both the active and the passive and the enhanced passive, and the ethical are all running off the same engine. It's all about the same asset allocation, the same decisions we're investing. The only difference being with active, we're using active funds. With passive, we're using passive funds. And with ethical, we're using ethical funds. So solid 1 year, 2 year, 3 year, and we focus on the 5-year numbers. So very strong 5-year numbers, but still that hump to get over for the lower risk clients. Market outlook. Now, this is where I'm going to sort of pause a little bit, and typically would have lots of images and pictures, but I did find one image to use in this instance, and this is shown there. And what does that sort of refer to? That refers to sort of like no change. I get it now from the sort of a revised sort of road signs, but irrespective of the budget, irrespective of the elections, our long-term view hasn't really changed at all. Now, regarding the budget, that is definitely more one for the financial planners and advisors such as Andrew to decide on how those changes coming through and how best they're going to affect his underlying clients. For us running money, there was nothing in there that for us to change how we're going to run money. And even though it was a significantly big budget in terms of taxation being raised, at least Rachel Reeves came out and said it was almost like a one and done. They don't expect to have another budget of this magnitude throughout the rest of their term. So I think that's going to give a lot of participants in the markets a bit of confidence that there's going to be some stability. So we're not going to end up having a death by 1,000 cuts. This was pretty well articulated. I totally agree with Andrew. There are certain things they could have articulated better in advance, such as tax-free cash. But we always knew they were going to raise certain levels of tax. And I think what they did was they put the worst news out there, decided how that was going to react, and sort of found some sort of halfway house. So from an investment perspective, there's nothing for us to make any changes based on the budget. In fact, I think from a longer term view, and you'll see this and where we are positioned, it does make, I think, investing in the UK more attractive than it has been because of, I think, of this political stability. We'll come on to that in a moment. The US is a very different kettle of fish. We sit with a very well diversified portfolio. We are spread across different equities, and we don't want to make sure that any single area is driving all of our returns. Our peers have a different approach. A lot of our peer group, for the equity content that they're dealing with, have up to something 70 to 75% in equities. So 3/4 of the risk all in equities. Now, from our moment in time, equities in the US are highly valued, and I'll show you how highly valued are at this moment in time, which leans us slightly away from there. But over this short-term period, as Andrew showed you, the S&P 500 going up and the UK going down, that was primarily down to Trump's trades, whereas we had an expectation for, the market had an expectation for bonds to go down because these Trump trades are going to be considered inflationary. However, what we actually saw was a spike the day after and a collapse back to where they were for yields in the long-term space, the long-term yields. And this was down to A, fear of inflation kicking in, but B, the Federal Reserve coming out 2 days later and signaling that they will be cutting rates and looking to cut rates future in 2025, same as the Bank of England did. They're giving themselves a little bit more latitude. They're not specifying exactly when they're going to cut these rates. They want to see how this news and how the money is going to be spent by both Trump and Rachel Reeves and how that's going to affect the market. So positively optimistic, I think, going into 2025. We'll know a little bit more next month when the Federal Reserve meet. That's where they give us their forecast of where they expect rates to be at the end of 2025. I'm sure a lot of people will be heavily focused on that, but inflation continues to come down. And don't forget, a lot of the inflation that we have experienced in the past was down to supply constraints, global economies being shattered because of COVID. That's fixing itself. So a lot of the pressures that caused the inflation in 2022 and 2021 have dissipated. So I think there's not overly much to be too concerned with at that moment in time. For equities, equities did exceptionally well, particularly US equities, as Andrew showed you. That was focused mainly in small cap and domestic equities, the Russell 1000 and Russell 2000, which cover the smaller end of the companies, did exceptionally well, overperformed the S&P 500. So that was great. And we think the reason we had FTSE and Europe go down is because one of the things that Trump was stressing was the stronger tariffs he's going to pose on European goods, not just China, but European goods. And obviously the collapse of the German coalition over the weekend would probably trigger an election in Q1 for Germany. So Europe, not UK, Europe as a whole, probably looking less positive. So where are we positioned at this moment in time? A lot of what we do is based on valuations. It's the old adage of, if you buy well and invest for a long period of time, that's where your value is going to come from. And what we have here is a chart showing you the 12-month price earnings ratios. Goodness me, what does that mean? What it means is for every pound of profit that you're buying in that area, how much is it costing you? Because you're buying with equities the forward earnings of all the underlying companies. So of those earnings, how much is it costing me today to buy a pound of those earnings? And if you're in the US, currently it's at 21.6 times, which means for every pound of earnings, it's going to cost you £21.60 to buy that. Another way to think of it is you buy a pound of earnings, that's your sort of earnings and cash flow and dividends. And if they repay that to you as a dividend, it's going to take 21 years for all your money to be repaid back just as dividends. Hopefully your capital is going up at the same time, but it's a really good measure of whether it's expensive or cheap. And here we have the US at 21.6, very close to its historic high. Its historic average at 16 times. So you can see it's paying a little bit over and above. Now for that same profit, that same pound of profits, how much does it cost to buy it in Japan and Europe? Roughly about £14 each. So you might be forgiven to think, okay, it seems fair value for both. But actually in Europe, it's above its fair value. So it's a little bit more expensive. And for Japan, it's below. So it's a little bit cheap. And in the UK, it's only £11.80. Now, we believe UK is probably sitting very close to its historic low And this is why we're seeing a lot of activity and movement within UK companies. So this brings us to our overall view of why we're overweight UK and Japan and underweight Europe at this moment in time. And when I talk about underweights and overweights, we're not getting rid of one asset class and bringing everything in for another. It's slight movements away from the long-term asset allocation, which roughly gives an equal level across UK, US, Europe, Japan, global emerging markets, and global developed markets. So for the UK, I've mentioned valuations, good solid growth, but also while you're waiting for the growth to come through, very attractive in terms of dividend yields. The UK has always been a very good place for dividend income. And also, we're seeing a lot of share buybacks. Now, what does that mean? Once a company has paid its tax, paid its shareholders in terms of dividends, if there's any excess profits, they can be used however they wish. Some instances, companies want to buy back their shares because it's not very good just sitting on cash in the bank. That's not going to earn you enough. If they think they're going to earn more by actually buying their own shares back at a cheap price, they see that as a good investment. Now, for us, that tends to be a sort of green flag for companies that are doing that, because obviously they can do a lot of different things. They can do their own mergers if they wish. But buying back shares tends to be a really good sign for the health of a company. And typically as well, mathematically, by taking more shares out, by buying them back, it increases your earnings per share as well. And we've also seen an increase in mergers and acquisitions in the UK. Companies that have been bid for recently: Rightmove, Hargreaves Lansdown, Britvic, Royal Mail, Wincanton, Redrow, Crest Nicholson, all good companies that people are finding extremely attractive. And one of Rachel Reeves' objectives was to make the UK a more investable place. Now, that doesn't mean it might be uncomfortable for people paying taxes and for your financial planning and the economy overall, but for companies, markets in the UK, I think she's going to try and really make the UK more attractive. And it hasn't been attractive probably since 2016, since Brexit. So there's a good opportunity here, we believe. Same goes for Japanese equities. Valuations are really good. But for us, it's the corporate reforms we're seeing. Now, since Abe was Prime Minister over a decade ago, he started shifting the way Japanese companies are structured. Now, previously, they were pretty much owned by large family conglomerate corporations. They were very insular focused. He's changing that to make them more shareholder friendly. He wants these companies to be paying dividends, to be wary of shareholder concerns, and make these better investments. And we're seeing that come through. So Japan at the very beginning of this year was the best performing asset class, and it's done exceptionally well in the last quarter as well. So you don't have to invest in the US just to get growth. There are other areas for growth to be had. And that's why we believe diversification over the long term really benefits. If we're overweight two asset classes, it means we have to be overweight something else. We're currently underweight European equities. Valuations are looking a bit expensive compared to the historic valuation over the long term. But also we believe there's a little bit of political instability and structural instability as well. So it's an area we wouldn't necessarily have more confidence in. And we have more confidence in Japan and UK. Covering off the rest of the equities, global emerging markets, we continue to remain neutral on. They benefited from the stimulus measures published by China at the end of September. That drove all of emerging markets up. China went from the worst performing asset class to one of the best performing asset classes. And in the US, we're neutral. We still feel valuations are stretched, and there will come to a point when those valuations will come down. We feel confident holding a diversified pool of that. I think those peers that are holding considerable assets in there may be doing well in the short term, but I think they're sort of giving up that long-term benefit in there. Trump should be beneficial for the US, but we feel it may be in the small cap area as well. Diversifiers, you don't want to just be in equities, you want something else to balance that out. Our diversifiers are in bonds, they're in absolute return, and they're in property and real assets. A couple we've picked out, listed infrastructure is doing particularly well. often benefits from a slowing down in inflation and that reduction in interest rates. Think toll roads, think airline, shops and concession stands, and also commodities. Commodities are really good. They can be sensitive to global slowdown, but we're seeing the stimulus put in by China, and I'm sure Trump will increase economic growth in the US. Commodities should do really well. They also hold up when there's a lot of geopolitical stress, but let's hope that Trump can follow through on a lot of his promises that he made about peace in his election campaigning. So that's where we're positioned. It's still making sure we have that global diversification, and I'll come across and show you shortly why the benefit of having a diversified portfolio works over the long term. But let's have a look at one of the underlying managers that has recently entered the portfolios. This is Skerivore Global Emerging Markets Fund, run by Glenn Finnegan. Now, we invested in Glenn when he was at Janus Henderson. You can see here from this multicolored chart, it tracks his different periods of where he's at different companies, from First State to Janus Henderson, and more recently to Skerivore. Now, we like Glenn. He's a really good manager. It's really hard to find a manager outperforming in global emerging markets. Here you see global emerging markets as a whole producing 3% per annum, whereas Glenn is producing 8.3% per annum. So it's really hard to find someone who's really delivering on there. The way Glenn runs, he's looking for companies that have strong corporate governance, not always the norm in emerging markets, and with quality management. If you combine those two together, what you end up with is a portfolio of companies based in the emerging markets that tends to have a really good downside capture. What do I mean by that? When markets are dropping, Glenn's portfolio tends to drop considerably less, but it does capture that upside as well. So we added Glenn into the portfolios in September 2024, so just over a month ago. And he's doing exceptionally well. We're pleased to have met Glenn and the team. Continues to be a really strong provider. And the reason we wanted to show you this fund is not one of your normal run-of-the-mill retail names. You're not going to see Glenn's company plastered in an advert in the Sunday newspapers or on the side of a black cap. So just that we make sure, and the investment team make sure, that we're really digging deep on finding the right managers, wherever they may be, to fulfill those criteria that we have in the portfolios. So that's covered off performance. That's covered off how we're structured. Hopefully, no surprise, not really many changes that we look going forward. We often find, if you look back to 2016, some of the doom mongering that was around Trump never sort of came to fruition. But what we're going to do now is just remind you of some of the key elements of being a long-term investor. Now, it's about staying invested. And what we've got here is a chart produced by JP Morgan. It's showing you 12 bull markets since 1970. And what's a bull market? That's when the markets are going up. And it's signified by a rise from a low point by more than 20%. And you can see here, the average length of a bull market is about 4 years. And they can be significantly high, or they can be modest as well. We had, 36% in sort of 2019. We had 103% throughout after the COVID period. Currently 57% here, but they can be significant, and they can, as you say, they can last a long period of time. But if you know, they don't go up in a straight line. There are some bits and bobs, sort of drops and troughs within there. Now, if those troughs continue to come down, if you have from a peak to a trough of more than 20%, that's the opposite. That's the bear market. And you can see we've also had 12 bear markets since 1970. Now, they don't last as long, typically less last than a year. Significant drawdowns, so they're sharp, but they don't typically last as long as the bull markets. And here we have them both together, and you can see if you're invested over that period of time, you would have spent more time in a bull market environment than you would a bear market. And if you'd invested over that period of time, the MSCI World Index would have produced a very healthy return for you as well. The problem being, the bear markets we tend to feel emotionally 2.5 times more powerfully than we do the up markets. That's why when the markets are going down, that's where you see the media peddling their sort of very sort of negative emotional sort of headlines, this is where we feel more keen to sort of lead the markets, whereas it's important to stay invested. Now, just in case you can't remember which is a bull and which is a bear market, they were described after the animals themselves and how they attack. So a bull market attacks with its horns in an upward motion. So bull markets go up, and a bear market, it claws downwards with its claws. Hence why we have bear markets going down. Now, why am I showing you this? We had a very poignant situation in the last quarter in August, and you can see here in the quarter the market dropped significantly in that sort of first day. World equities dropped 6%. Other individual equities, the US, Japan, they dropped considerably more. Now, why was this drop in the market? Well, at the end of July, we had the Federal Reserve meeting and they hadn't cut rates yet. And this was an expectation was rates were going to be a cut, but they didn't. They came out and said, we're going to wait for more data. Data did come in the form of a jobs report the following day, and it was quite a negative jobs report in terms of unemployment increasing and less people seeking jobs. So the concern here was, well, the Federal Reserve didn't cut rates because they think we might be going into a recession. So suddenly the recession risk reared its head again. So we've been waiting for central banks to cut rates before they actually call to recession, because typically central banks cause the next recession by having rates too high. Very dangerous game. And what we had then was the day after that, we had the Bank of Japan have a surprise announcement for they're going to raise rates by 0.25%. Now that completely spooked the markets, and we saw a massive drop of 6%. Japan dropped 16% in its global markets. US dropped double digits as well. But you can see here, over the next 3 or 4 days, the markets recovered. Why? The Federal Reserve came out and said, we are likely to cut rates at the next meeting in September, which they subsequently did, but they didn't know that obviously at this point. Japan came out and said, we're not going to be making any more interest rate rises. And when you actually read the jobs report in detail, it didn't look as bad as it was. What you just had was this knee-jerk reaction because markets were super volatile over that summer period. It just reminds you that even over those couple of days, it's important not to knee-jerk. It's important to keep to your long-term financial plan. Now, we're going to spread this out over yearly periods. I'm sure you've seen this chart before that I may have delivered. So it goes back to 1984. It's MSCI World, and it shows you the calendar year returns for each year. So in 1984, if you stayed invested for the whole year, you got a 30% return. And you can see here, the longer you stay invested for, the more chance you're going to pick up more positive years than negative years. So around about 70-odd%, which is really good. Now, as we know, as we looked back into that August, there are points in the market where it is a low point. And here you have what we call the measles chart. So it's avoiding to catch a cold. And you can see here, this highlights the lowest point in the market at that point in that calendar year. Let's go back to the obvious one, 2020, COVID hit. There's the low point. Markets dropped to nearly minus 20% in world markets. Now, if you'd have sold out, then you're crystallizing that 20% drop. Whereas if you'd stayed invested at the end of the year, markets had gone back up to over 10% return. And you can see here, every year, the market goes back above where that low point was. Sometimes it's positive. Sometimes it's a less negative. It's really important not to be sort of lured in by these low points. And if you look at 2024 here, that low point wasn't -6, as I just showed you, because throughout the year, that -6 still didn't drop you into negative territory. The low point was in January when it dropped about 2%. So it's about staying invested, keeping to those long-term returns. And it's about being diversified. And as I said, we have a diversified approach to our risk content, the equities. We want to make sure we have a portion in each, and we slightly tilt where we think there's some outsourced opportunities over the medium term. So at the moment, as I say, overweight UK, overweight Japan. But you can see here, if you go into individual asset classes, sometimes it'd be good. S&P 500 in 2023, best performing asset class. Year before, not great. 2017, not great. You want to make sure you have a blend of both. What you're trying to achieve is this middle period. And here is our balanced approach. Think portfolio 5, whether that's active or passive. If you had the asset allocation for portfolio 5, you can navigate this middle period, it means you're never going to pick the best because you're diversified, but you avoid the bottoms. If you can avoid those bottoms and sew those averages together, that's what gives you the exceptional long-term returns. So keep diversified. It's about making sure you have different investment styles as well as different asset classes. So growth and value, large cap and small cap. Making sure you pick the right managers. We've got 35 within our standard sort of portfolio 5 approach, covering 47 different countries. And if you underline all of those stocks, there's over 19,000 different holdings. So fully diversified. So just key takeaways. Strong performance for the year to date and over the long time across all of the products we run. So that's really important. We're seeing attractive opportunities in both equities and diversifiers. So think commodities, think listed infrastructure, but also think the opportunities in UK and Japan as well. Key for us is we continue to buy diversified. We don't want this binary outcome of any one asset class driving the returns. And as always, our opinion is stay invested, get invested. Don't react to short-term market movements that you might well see at least to the end of the year as a lot of people weigh in on the budget and as well as Trump, and stick to those essential long-term players that Andrew and his team have put together for you.
Are you going to ask questions on that last slide?
Yeah.
If anybody read
ask
the
questions
slide.
now.
Super. Thank you very much for that, Shane.
Pleasure.
If you want to take your slides down for a second.
Yes.
We're just showing your Zoom page at the moment.
There we go. That's fine. I was trying to find where it was stopped sharing.
No problem. So thank you very much for that, Shane. We've had a few questions come in, which is really good. A couple of them you may well have covered, but might go through them again. What do you look for in a fund when you're choosing to invest into it?
Really good question. The way we want to invest is with every asset class that we're looking at, and not to sort of dumb it down. Everyone thinks of a Trivial Pursuit section, whether you call it pies or cheeses. So every segment, we want to make sure that that segment has diversification. So we're looking for a value manager or a growth manager or an income manager. Once we've decided who we need to find, is finding those managers that exhibit a consistent approach to growth or value or income or quality. What we don't want to see is a manager that switches from one to the other, because then at one point we might have an overweight in an area we don't particularly want to. So we want to have control of those different areas. Once we've found a manager that has that consistency of approach, it's then about making sure that he can actually do the job he's doing. Has he got lucky, or is he actually delivering really good returns through great stock selection? The investment team have built some really strong proprietary models that take the data, and we can identify how that manager's returns have happened over the particular periods, and it will tell us whether it's been through luck or it's been through skill. And then ultimately we interview the fund manager to get to understand the person and the team behind it. So it's this qualitative and quantitative approach. Once we're happy, then we talk about costs. We want to make sure we can drill them down. For costs, we want to make sure our clients aren't paying us as much as they should be. And once all of those 3 boxes are ticked, then we look to invest.
And what might be a typical time period from you starting to look into a manager to them actually being, promoted off the subs bench?
That's great. So really good point about the subs bench. So probably takes good 6 months to fully analyze a new fund. So if a new fund comes into our area, if a fund manager sort of hits our radar, like, right, we need to have a look at them, probably takes a fully 6 months to make sure we're comfortable on how they're running the money. Then we can decide to add them into the subs bench. Once they're in the subs bench, they go through the normal process of 6 monthly reviews. But once we've decided we want to bring a manager in from the subs bench to the fund, it happens as quickly as we can make it happen, typically at the beginning of a month. So we have our investment committee meeting tomorrow. So our investment committee meets tomorrow. If we make any changes, then that will come forward for the 1st of December.
Okay. And, managers go through different periods when they're doing well, they're not doing well. Sometimes it might be what they're doing isn't quite right, and sometimes it might be that they're just out of favor, so they're doing a good job, but they're not in favor of the market. What would make you then decide to sell a fund?
It's a really good question. So, two really good examples of managers that were out of favor. We hold a smaller companies fund in the US. This year, it's all been about large cap, large tech, your Microsofts, your Apples, etc. This past week, with Trump getting in, that's been one of the best performing funds of all funds, not just US funds. So we're happy to hold funds with this sort of combination of, we know funds are going to be out of favor at any one moment in time. We don't know when funds will suddenly switch. We're not about market timing. So we're happy to hold those as long as they continue to do what they do. So we're happy to hold a fund that's underperforming as long as they're continuing to invest in the way we want them to invest. We have a fund in the UK. I can't mention any names at the moment. Their stock selection hasn't been great of late, but they've got a really good track record. We've sat down with the management team to discuss, what are you doing about it? Why are you holding on to these stocks too late? Are they falling in love with their underlying holdings too much? Why aren't they sort of, moving their portfolio across? They talk a good game. Chris and Millen went in to see the analysts at the firm, sat with them for a whole day and went through the whole investment process, because we got the impression that they were believing the management teams too much at face value and not doing the underlying work. So in that instance, it's still out for the jury at this moment in time, but potentially we might be selling that and bringing in a new fund. So yeah, it's about making sure that a fund gets sold when we stop believing they're doing what they should be doing.
But it sounds like it's not a knee-jerk reaction,
No, not at all.
Something happens and then there's investigation as to why. It might just be market timing, or it could be something more difficult, that either key team members have moved on or they're just not doing it anymore.
Absolutely. But once we make the decision we need to sell, we sell straight away. But it takes probably, I'd say, a good 2 months to come to that conclusion, because you say you don't want a knee jerk. It might be they're up again next month, but we do keep a track record of, hang on a minute, they might have been on the radar 3 out of the last 6 months. So let's just keep a track on those, please.
Yeah. And then quite a specific question from one of our clients, that they noticed that their active 6 portfolio jumped up over 3% over the last month, and into sort of middle of November. What's caused that? And an even better question, what's next?
Yeah, we're seeing some huge leaps. So for portfolio 6, it would have been a lot of emerging markets driving that as well as the US. We've seen China come out with its new stimulus package to try and revigorate the Chinese economy. That did well for China, but it also waved through a lot for other emerging markets. US is doing still particularly well. We're getting good returns from Japan as well. So pleasing for us, it's not just one area where we're getting the returns. It's through lots of different sleeves that we're getting those returns. And we also hold some sort of long dated bonds as well, which is doing particularly well as interest rates coming down. So from our point of view, if you've got a sleeve of 30 different lines, we want to make sure, maybe half are doing your returns. If it was only one, if I gave you one answer, Andrew, and it was like, it's just X, I think you should be really worried, but it's coming from lots of different streams. Going forward, always a little bit more difficult, and you always love putting me on the spot for this one. We are finding very little to be pessimistic about at this moment in time. We're still seeing inflation coming down. I'd still like to see the central banks still bring their interest rates down a little bit further to this sort of neutral position of beginning with a 3. That'll be really handy. I think that's an environment where you can have real returns on all your asset classes, and I think that's healthy for global economies overall. We're just going to have to wait to see what Donald does. We're going to have to wait to see how a lot of the budget's money raised is actually spent and actually done. So, yeah, I think there's a bit more stability in the areas we like. Areas of concern, I think continental Europe as a whole is a concern in the medium term, but I think everything else outweighs that. So positively optimistic going forward.
And from a lot of it as well, what impact do exchange rates happen for a client's portfolio?
Interesting one. So we don't want currency being a major benefit or deficit to the portfolio. So we don't hedge our equities. We take whatever the swings and roundabouts are for currency in there. But when we have a weaker sterling, when the overseas assets, euro, yen, dollar, get translated back, you end up with a bit of a kicker going forward. So if I take you back to August when Japan dropped 16%, because we had a weaker sterling, we only dropped 11. And when it recovered, we got the bonus of that as well. So for us, having a strong dollar and a weaker euro helps those benefits. But over time, Andrew, over the 20 years that we've been doing this, it comes out in the wash. But yeah, we don't want to hedge currencies because that can really hurt.
Yeah, brilliant. Well, thank you very much for that, Shane. Really enjoyed your presentation, so thank you very much for that part. Just finishing off on it from there. Just want to say thank you to everybody for your taking the time to listen today. As I said, we will be sending you an email afterwards asking for your feedback today, both on the content, the information you've received, any particular questions you've got you'd like us to address, and any thoughts and plans you'd like for us to do in the future. So do let us know any topic suggestions from there. That's my little compliance slide I need to put at the end. But I'd just like to say, yeah, thank you very much for everybody for listening. Take care.